understand it and be in the market, you better think about how to trim up. Now, for MMTs, let's talk about you. We can clearly see the Dow and the S&P, how overbought we are here and how overbought we are here. If I want to go to a third chart and throw in the Nasdaq comp, which is hitting all-time highs right here, it's already up here, and it's at 94% overbought, heavily tech related. We are already coming back up to where mathematically I went down and mathematically I levered up. So when the financial crisis started, just like it did back in the 1929 crashes and in the 30 re-leveraging up the tape, they all failed. They all failed. But they're great to make money on. Bear and bull side of the market. Who cares? Make money on both sides, you really do well. Here's that trend line on the Nasdaq comp. There it is, and we're pushing that right there. Back when we shorted that Nasdaq comp, March 10th, way over here, we've re-levered up. We're making all-time highs. There is 3,000 right there. That could pop right up there. We have had weekly buy signals for 2011 and 2010. That's what's fueled that train, and the train has left the station, and people have been buying into the Nasdaq comp. And I'm just showing them all three here so that you can see that you're overbought here, but you can go higher overbought here because you can see how overbought down here in the percent DS on the Dow. You're 97. You're not going to stay up here. The S&P right here, you're not going to stay up here at 96.59. What we're going to be doing is that when the indexes start to take their first distribution and their first pullback and correction, individual names in various different sectors will pull back with the broader indexes, and that's where the short side of the market would come into play. And we're not very far away. And everybody thinks that there has to be a spring rally. Well, guess what? You've already rallied in anticipation. And what markets and indexes like to do is they like to get way ahead and they're forward looking. They like to price those rallies in where people think the same event occurs over and over. But guess what happens? It's time to ring the cash register and bank some of those profits. So between the bull, which is extremely bullish, and the bear, who's been, well, unfortunately in the short term, the bear has suffered. However, the trade management moving forward is that March Madness is March Madness, all right, where it will show up. It's going to be harder and harder to break higher in all of the indexes because the current money flows are at their highs. And it's the first time since the financial crisis, instead of money flows going out, that they've come in, because they have in the mutual fund community. And that once again, it takes a lot to get the investor back in. But my goodness, every time they seem to come back in up toward the highs and the financial crisis, we're not out of the clear yet. Look, there's going to be a time where Ben Bernanke can't do what he's doing. And commodity prices have leveraged up these tapes around the world. That's part of the move in all of our indexes. We don't have an inflationary problem yet in the U.S., but it will get imported over here later toward the end of the year. 2012 is not going to be pretty. No. The trade on the S&P and the Dow both is that safe haven money coming in. The problem is, for the bull, is that here on the Dow, like I said, if you see it clearly down here, we're at all-time, we're at the point of no return at 97. You're not going too much higher, I'm sorry. Time to get net short on the pullback. And the pullback is that we haven't shorted these markets. We've been the dip buyers every time when they pull back a little bit. The pullbacks were shallow. Naturally, we went right in and got net long. However, that trade's coming off to a stop. And we don't have any support until we test some of these 10-week moving averages down here. Chasing performance, is to see if that money continues to come off the sideline. As I said in 2010, is that you can't have another great bear rate or another great bear rally to the downside until you suck it all off the sideline. Get all the money in and say, hey, goodbye. It's called this right here. At that point in time, it's going to be something like this.
Goodbye.
And it's going to be time to ring the cash register. So it's important that when we get with our trade management in the short 5-day periods, 3-day periods, 5-day periods, is that we're going to be looking for the weekly reversal, not a week. These little weekly pullbacks that we had here back in 2010, we're only pulling back to the 200 week on the Dow. One thing about the Dow is that 200 week is descending in value while we've had this up move. And we're over the MACD, is that screaming at the high, the percent DS. That's standard technical analysis that the broader community, that's all they have to go on. A market maker that works within the exchanges, well, hey, we're going to start looking at some put options below the market. We're going to look at the timestamp. That's the Dow Jones. I've showed the Nasdaq comp. Here's your S&P relative to how overbought markets are. Time to start looking at the put side of the market. Individual equities roll up. Each individual equity that has an overbought is going to have to pull back. Earnings are out of the way. Options just expired on Friday. They're out of the way. Today's date, 2/19/2011. Time is 9:18 a.m. Pacific Standard Time. As the exuberance mounts, just like it did back in the flash crash that we called back in April, is that we're coming to that area. And that this parabolic wedge type move up here, they got to fade back and pull back. And this is why we like that S&P 500. That's how I'm going to conclude the indexes. And we're going to take a look. We got a 3-day weekend, and we're going to take a look, especially on Monday. We're going to be here, and we're going to develop nothing but alarms on the upside. And we are going to take a look at the leadership. We're going to be taking a look at the extended bull that will make great short when the Nasdaq pulls back. Apple's a big weighting in here. Look, we just made another 52-week high. We've made series of 52-week highs. That's very bullish for everything. But I'm sorry, there's one thing missing here. And the thing that's missing here is the exuberance on the Nasdaq comp. There's going to be a pullback. It's not far away. And we'll let the SMF market maker platform tell us when that's going to happen, because it will. And the broader profit taking and distribution, right here, there's only 30 stocks. It's called a Dirty 30, biggest gimmick in the book. And you can see that when we pull back on all indexes is where that bull is. But let me tell you something. Higher oil prices at 120 and higher. Commodity prices continue to inflate around the world. Supply and demand disruptions are around the corner. Then the bull's going to have to start rethinking. The bear is already growling right now. And the thing about it is, every market top has a pattern to it, and a behavior pattern to it, and a thinking and a psychological pattern to it. And that's what's happening. You've been given a gift. We will go over lots of various trade management scenarios to take advantage of these pullbacks. We'll let the public stay at the top. When they do pull back and test weekly moving averages, when that time comes, guess what? The bull will probably come back in again. We'll worry about that when we get there. But right now we're talking about we're too overbought on all indexes. You've been given a gift.